You're watching episode 51 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, a CPA and managing partner at the Real Estate CPA. And before we get started, I invite you to join our Facebook group. Link to that is in the description below. I also invite you to check out our TaxSmartInvestors.com subscriptions. We have 3 tiers, a content subscription. We have an insiders Facebook group that's starting to take off. And we have a special email and call service where you can get advice from our team of CPAs. Highly recommend that you check that out if you've been enjoying these videos. Now, today's topic is on Section 121, and specifically how I just saved somebody about $23,000 because they posted in our TaxSmart Facebook group asking a question about Section 121, explaining how their CPA was interpreting it, and it turns out their CPA was incorrect. So I was able to jump in, add some clarity, and it turns out that they didn't need to go through everything that their CPA was talking about, which will save them about $23,000 in taxes. Section 121 is the capital gain exclusion piece of the code that everybody talks about. So if you've ever heard of that $250,000 or $500,000 if you're married filing joint exclusion from the sale of a primary residence, that's what Section 121 is. In order to qualify for the $250,000 and $500,000 capital gain exclusion, you have to own and use a property as your primary residence for 2 of the past 5 years. So if we're looking back on this now, you would have had to own and used your property as a primary residence for 2 of the past 5 years. We're going all the way back to 2016 in this look back. So that's our 5-year window if we're looking back today. So own and use 2 out of the past 5 years. So if you used it in 2016, 2017, owned and used it 2016, 2017, full 2 years, and then rented it afterwards, you qualify for the full exclusion, $250,000 or $500,000 if you're married filing joint. Now, the issue that popped up in the Facebook group that I helped with was a question about non-qualified use. So you can only qualify for the full Section 121 exclusion, again, the full $250,000 or $500,000 on the sale of your primary residence, if you have no non-qualified use. So all of your use has to be qualified use. And what was at issue was whether or not the rental period after the time that I've used my property as a primary residence and owned it as a primary residence, after that period, so I use it, I buy it, I use it as a primary residence for the 2 years, I move out, and then I rent it after that, is that period that you rent it after you move out, after you have used it as a primary residence, is that considered non-qualified use? Because if you do have non-qualified use, then you have to prorate the gain that you're allowed to claim. That $250,000, that full exclusion is no longer available to you. So it's really important to figure out, do I have qualified use or non-qualified use? Now, if you live in a property for 2 years, at least 2 years, and you own it for at least 2 years, and then you move out and then you rent it, the rental period after your use is not considered non-qualified use. Specifically, you find this in IRC Section 121B5 Cap C2I. So that's where you're going to find this definition that I'm talking about. It says that your non-qualified use does not include any portion of that 5-year look back after the last date the property was used as a primary residence by the taxpayer. All that means, again, is that if I used the property in 2016 and 2017, a full 2 years, and then I rented out for 2018, 19, and 2020, the 2018, 19, and 2020 rental period is considered qualified use for Section 121, which means that simply renting it out after I've used it for my 2 years is not going to result in me having to prorate that $250,000 or $500,000 capital gain exclusion. I still get access to the full exclusion. So the person in our Facebook group, their CPA was telling them that all rental period is considered non-qualified use. The CPA said, hey, you lived in it, then you rented it out, and now you have to prorate between the rental days and the personal use days. But their mistake was not identifying that the rental period after the last date that they moved out is considered qualifying use. And the taxpayer still gets the full exclusion. So the CPA's calculation showed them owing about $29,000 in tax. Our calculation shows more like owing about $6,000 in tax, mainly due to depreciation recapture, because Section 121 does not exclude depreciation recapture. If you want to see the full conversation, head on over to the Tax Smart Facebook group. Again, link below is in the description. Now, what would be considered non-qualifying use? We should probably talk about that. If you buy a rental property and you're renting it out from day one, and then you move into it to make it your primary residence, all of the rental period before the date that you move into it to make it your primary residence, that is considered non-qualifying use. At that point, you would have to prorate the $250,000 or the $500,000 capital gain exclusion. So I rent a property for 2 years and then I move into it for 2 years and then I sell it after year 4. I don't get 100% of the $250,000 or $500K exclusion. Instead, I would get 50% because I have 50% non-qualified use compared to my total ownership, my total use. So that is something to definitely be aware of and definitely be careful of. But again, if you buy a primary residence, you use it as a primary residence from day one, you hit your 2 years or even more years, it doesn't matter, and then you rent it out, the rental period after you move out is not considered non-qualifying use. It's considered qualifying use, still allows you to claim 100% of that $250,000 or $500,000 if you're married, capital gain exclusion for Section 121. Thanks for watching today's Tax Smart video. Hope you enjoyed it. Leave us a comment below if you've got any questions or if anything that I said resonates with you. Check out taxsmartinvestors.com. It's an awesome new website that we're running. We're providing a lot of great advice for folks in different tiered subscription options. So highly recommend that you go check that out and follow us online. We have a link to a bunch of social channels below. We'd love to have you be a part of our larger community.